Thanks, Carl. Hey guys, I'm Sean Patrick Fitzgerald, wealth advisor, former math teacher. Moved to Colorado in 2014. Love living here. Thanks for having me. Carl, thank you for this. I've been a wealth advisor for 12 years, and I've learned more in the last 10 months than I've learned in the combined last 12 years. The industry that we're in, what we're doing to help people finance these kind of opportunities, my mind is blown. I work with a guy, Jonathan Wield at Unbridled Wealth. He's a British engineer and brilliant. Pivot tables is his middle name, so if you guys want to see some serious spreadsheets, this guy can do it for you. Show you how this dog can hunt. So I'm married, I have 2 kids, 2 daughters, Kesset and Piper. She is the queen, she is the dream of my life, and I love her. So I get to support that by doing this. So let me just give you kind of a quick background on me. A lot of this stuff, I don't know how much you guys know about insurance. I've been in this field for 12 years. My understanding was the stack of books this high, that was Satan. Okay, that was my training. So just so you know, there's 2 stacks, and I'm going to talk about this stack because there's different types, all right, and there's different types of insurance. So the first type that we'll talk about, this is going to feel educational, so just stay with me, all right? Term life insurance is for a term. If you die, somebody gets an income tax-free death benefit. Everybody good on that? It only lasts for a certain amount of time. It's like renting your insurance. And it's awesome for certain purposes. The next types of life insurance are universal life and cash value whole life insurance. There's degrees of permanency in each one. What I'm going to show you guys is the glories of whole life and how it works, how it doesn't work. There's limitations to it, and it's not for everybody. If you're not healthy or you can't find anybody healthy in your organization, it is not for you, okay? Just be aware. Life insurance is not the end-all be-all strategy for the universe. I heard this one guy in Florida tell me that every problem was the nail and life insurance is the hammer. Okay, that actually has some truth to it, but it's not completely true. So R. Nelson Nash, he died this past year at age 92. He's been doing tax-free banking. He wrote this book called Becoming Your Own Banker. It gives case studies. It's not a good read. He's not a writer, okay? But it's really fascinating because it can show you what life insurance does and what it does not do, and how it can be a cash flow management tool literally for your business or for your opportunity zones. So the funding vehicle, we can come alongside commercial lending, any lending you guys need to get done. We can come alongside that, or we can completely replace it. At Unbridled Wealth, we're actually replacing the bank, and I'll tell you a story about that in a little bit. All right, there's 3 components to life insurance. The first component is premium. Second component is cash values. And the third component is the death benefit. Typically what you'll see out there is you'll see a premium, and let's make up some numbers. Let's say you put in $100,000 of premium into a life insurance contract, and it buys you, let's say, $10 million of life insurance. That's designed, and they've averaged out the cost of life insurance, and it's designed to last your entire life. If you die at age 100, it will pay out, income tax-free to your business or to your heirs. So that's the legacy component that you talked about. Typically what you'll see in design is this. In the first year, you have $0 in cash value. Most business owners, most people that want to buy real estate, this is not very attractive. What they're looking for is instant access to cash or access to cash in the first year. So what we've done in Unbridled, and this is something that we can help you guys set up, we can help you design, we can help you figure out, does it fit inside your business cash flow models or your reserves? What we've done is we've designed it differently than the way it's designed out there in the world. And let me show you that. What we've done is we said, okay, let's say the same premium amount was $100,000, but we're going to buy down the death benefit. Instead of 10 million, we're only going to do 4 million. So you're buying down the death benefit and you're dividing the premium into 2 things. The first thing you divide it into is base. The next thing you divide it into is called paid up additions, or PUAs. Some of you guys who have been in presentations or talked to insurance guys, like this may be an understanding for you already. But here's the distinction. What we've designed it to be is most of the premium is cash-rich, early cash value life insurance. Meaning $30,000 a base goes in, $70,000 goes into overfunding, or this thing called paid-up additions or PUAs. It is tax-free access to cash that has guaranteed growth. So in year one, you actually have access, and this depends on your age and your health. These numbers may be a little bit different, but basically you have access year one or day one to $70,000 tax-free. So it's going to grow tax deferred, and you can access the dollars tax favorably on the back end as long as you follow a few simple rules. So what we've done is we've taken and we've overfunded life insurance to the level that the IRS will allow us to go and not a step further. If we went another dollar different, what would happen is these dollars here would become taxable to the clients that we work with. So we get it to the IRS MEC limit and drop it down. And that's where we can overfund it and have $70,000 year one inside the life insurance. Does that make sense? So as a funding vehicle, this is how this works. Let's say, for example, you've got a life insurance policy that's cash rich. And you guys are savvy, so I'll ask you, how many of you guys are familiar with fractional reserve lending? Okay, this is what the banks will do. You ready? And I'll compare this for you. Let's say, for example, you've got $1 million sitting in, I don't know, Bank of America. And you drop it in there and they say, thanks for playing, have a cup of coffee, here's a massage, thanks for coming in, guys. We're going to pay you $3,400 a year in taxable interest. About 0.34%. That's the typical checking, savings, or cash reserve account that you can open with most banks. Now, the government's going to come in and do some work, and your net profit will be around $2,700 on that million. The bank then turns around and loans out that $1 million 9 times. Right? So $9 million goes out into the field. They loan it out, and they charge 5% interest per person that they loan it to, around 5.5 right now. So what happens is the banks take your million and they get it moving. They literally move it out into the marketplace and start collecting interest. So what is 5.5% of 9 million? About 450 grand. So while the bank is earning just an interest, this isn't even fees, around $450,000 on your million, they're paying you $2,700. You got a coffee mug though, right? Maybe a toaster. T-shirt. Best banks will give you T-shirts. And you may need to use banking for a while. That's fine. We've gone in and we started replacing the banks for this reason. They're getting a 16-to-1 spiff on the money that, for example, Unbridled has $6 million. This is my story. $6 million sitting on deposit in checking and savings, just waiting to be used. They went in and applied for a $300,000 loan and they were declined on a real estate opportunity in Canyon City, Colorado. So they went back and they said, hey, we've got $6 million. It doesn't have to sit here. And they reconsidered and they offered them the $300,000 loan. Right? So the trick with the bank is you have to have a FICO score, proven credit. You have to have a P&L that you submit. You need to wait 30 to 60 days. And then you can borrow money against what you have in the bank or against your net worth, right? That's how typically it works. It's not very nimble. So what Unbridled Wealth has done, and this is Jonathan Wield and Stan Bullis, they've begun to put $2 million a year through a tax-free banking system using whole life insurance. That's the premium they're putting in per year right now. They're flowing it through and they're buying real estate and they're expanding their businesses. They now have 21 companies they've started, 15 of them in the last 4 years. And what they're doing is they're actually expanding business and buying real estate. One specific opportunity is in Florence that we'll do at the end of the evening tonight. Does that make sense though? Banks are going to loan out your money 9 times and you're going to not be the benefactor of that loan. Does that make sense? So what life insurance is, if you had a tax-free banking system, and let's say, for example, you had $1 million sitting in a life insurance policy. This is how it works. It's literally how it works. And not every company is designed the same, but this is the basic premise. Let's say, for example, you come to your bank and you say, hey, bank of myself, I'd like to borrow $900,000 this year and go buy some real estate. Would you like to make me a loan? And you tell yourself, yes, I'd love to make myself a loan. Thanks for playing. And you drink a cup of coffee out of your own coffee mug that has Bank of Myself written on it. Okay? So what we do is we come in and we say, let's say we're going to borrow out $900,000 from our own bank. Go buy real estate, put it into Opportunity Zones. It's a financing tool for business. It's multi-purpose money. You can use it for any purpose because it's your bank. You don't have to get approval. You're going to charge yourself 5% interest fixed for life on that $900,000. And what you can do with that is you can come in, and after you charge yourself 5%, if you start repaying principal and interest, you're actually only spending 2.73% of your own money. That's your cost for using your own money. And if you run it through an LLC, but depending on your tax bracket, you can get that down to about 1.8% loan on your own money. So your $900,000 comes to you at a cost of 1.8%. Now what's happening behind the kimono? These insurance companies, they've got this ledger system in which they say this is the loan department, this is the cash value department. The full $1 million is growing at 4.5% tax-free, meaning you're up $45,000 tax-free, tax-deferred inside the life insurance, and your cost of money is $18,000 a year if you set it up correctly. What would your world be like if you could use $900,000 for any reason at any time in 7 days? Literally, we'll send you something on your phone, you click a button, and the loan comes to your bank account. You literally sign it on your phone. The 900 grand comes to you, you go buy your real estate opportunities. Your money, the full $1 million, is still growing at the full dividend crediting interest rate. And it's creditor protected up to $100,000 in the state of Colorado. And it's tax-free. I'm just going to let that sink in for a second. That's a lot of information. So while they're giving you $2,700 taxable over here, you could be making your $45,000 tax-free over here per year and have access to your money. You get access to 95%. I couldn't do the math in my head, that's why I didn't put it. You have access to 95% of your money in 7 days. Can you be more nimble? So Jonathan and Stan, when they were down in Canyon City, they bought the Hotel St. Cloud at a live auction in eight days for $88,000. Did it over the phone. Wired the money from the life insurance. Now they're hotel owners. And now they're going to put about $7 million into it. Now that's not an opportunity zone, but Florence High School is, which we'll get into at the end.
Can you buy whole life policies with capital gains? So can you defer into a whole life policy?
Mm-hmm.
Yeah.
That's what we're doing.
Okay.
So the taxes that Stan had, and this is the example that we're going to use, yes, I'll show you that. Yes.
So you could sell real estate, sell a business, whatever. You have that. I'm looking at a $150,000 tax bill, or buy a whole life policy.
Use whatever you're going to give to the government, dump it into a whole life policy. You got it. Pretty simple. It grows. It's an after-tax contribution, so it functions like a Roth on steroids. The only limitation you have is how much do you want to put in, are you healthy, and can you financially qualify for whatever amount of life insurance that you want. And the other trick is finding people that are healthy in your organization. If it's you, great. If it's somebody else, we just talked to a guy yesterday, he wanted to put it on his daughter. He's 67, but he wants to do real estate deals. I'm like, why don't you use your daughter's life and insure her? You stay the owner, and you dump a bunch of money into these life insurance policies. We'll start buying real estate out of the life insurance. He's like, you can do that? I'm like, yeah. The only difference is when he's 67, he would only have access to, remember I showed you the 70-30 split? He would have access to about 50 to 55% year one as a 67-year-old, instead of having access to 70% when you're younger and healthier. That's the only difference. Does that make sense? Questions? That's a great question.
So why don't you follow up with who can be an insurer?
That's a great question. Anybody you have a financial interest in the business or personally in your family. So Stan, they ran the mortgage on Grant Street down here through his wife Cindy, and they're putting $400,000 a year through a policy on her to pay off the mortgage on Grant Street. And I can show you guys the example if we have time to see it. But they pay off the same mortgage to A&B Bank in 15 years, and they make $800,000 tax-free, same time frame, by just running it through a whole life policy. And the wife was the insured in that case. So she has a business interest, and therefore she can be insured. You know, there's things that happened in New York where this lady she was going around insuring homeless people and then knocking them off and collecting the benefit. So she got caught, right? She had no financial interest in these people except to kill them, right? That's who you can't insure. That's an extreme example, but it's real.
Unfortunately, that sounds very much like an angel investor.
Doesn't it? Ever heard of viaticals? Now, one thing that we hear a lot about, and I'll just quick education on this, Universal Life does that work for infinite banking, and it doesn't work as well, and here's why. Universal Life is a chassis that is less permanent, and I'll just put all, than whole life guaranteed cash values. The cash values in life insurance that's whole life are actually guaranteed to grow every single year at 4%, tax-free, no question. It must do so. Now, dividends have put it up as high as 13%. That's an outlier. They average around 6 or 7% dividends tax-free inside the life insurance using a mutual carrier. Stock-held carriers usually keep a little bit off to the side, or they don't do as well with their investing typically if they're stock-held. So we use mutual carriers for that. That means there's no stockholders in the insurance carriers. The most permanent version of life insurance is whole life. Second to that is universal life, and I'll show you why. How many of you guys go to Vegas? Vegas? Okay. You guys realize insurance companies are gamblers too? Did y'all know that? They love to gamble with you. So tell me your name again. Daryl. You're a young guy, so I'm going to pick on you. Is that cool? All right, great. So, you know, the insurance company would love to make $1 million bet with you. Okay, they're going to bet that you live this year, and you're like, "Hey, man, I don't mind doing that. Send the nurse to me. Poke my finger. I'll pee in a cup. I'll get underwritten for that, no problem." And then you say, "Well, what's it going to cost me to gamble?" And they say, "Well, I don't know, $55 a month." And you're betting that you do die. They're betting that you don't. And they send the nurse to you to make sure you're not that high of a risk, because 99% of these policies never pay. 99%. So the house wins, right? So you're going to gamble at $55 a month, and then next year what happens? Are you dead? Of course not. But, hope not, right? I mean, you own it for a reason. You could be dead. Well, they'll up the ante just a little bit. Not too much to insult you, right? Because you got a 0.003% chance of dying next year, right? You could be the guy. So this goes on into your 50s. By the time you're in your 50s, they're like, "Hey, you want to keep betting? $1 million." And you're like, "Fine, what's it going to cost me this year?" They're like, "Hey, no worries. You know, we'll bet you $1,500, about $130 a month. We'll bet you $1 million that you're not dead." And you're like, "I bet you $130 a month I am." And you know, if we're Vegas, right? If you got a 1% odds of winning in Vegas, is that a good odd? How about 2%? I mean, the house has a 97, 98, 99% chance of winning, right? So this can go on into your 70s and 80s. I'm not making this up. We literally just insured a 72-year-old right here. He did a whole life plan because he had a bunch of real estate that he had to make sure he covered the debt on if he died, because his wife was hosed if he didn't pay this off if he died. Goes over to Europe a bunch, like he could be dead, right? 7 rental properties. This is their retirement income. He's spending $25,000 a year for $350,000 of coverage.
What?
But it's got to pay. It's guaranteed to pay. It's over here. If he dies at 100, it'll pay. If he dies at 120, it's going to pay. But he bought it when he was 72. He's healthy. I mean, for an old dude, right? So, we can literally get into I'm not making this up. This guy, if we ran his term insurance, and it was $1,300 a month. So I'm just going to put that down. Let's say $2,100 a month in your 70s. Because are you getting closer to dying when you're 70? House isn't going to lose. right? Y'all know the house isn't going to lose. So what happens with this is they come over here with a universal life chassis, and this is just, it's not evil, it's just different, okay? And it looks like this. It's an insurance bucket that's $1 million. And they put cash in the bottom of it. Now, in the side of this bucket, they're saying this is going to pay to your family whenever you die, except they may not disclose to you, it depends. There's a hole in the side of the bucket. And in the side of the bucket, that hole is exactly the same size as term insurance. You mean my $55 a month that goes up to $2,100 a month is my term insurance costs? Uh-huh. You have no guarantees on your insurance costs. They rise as part of the contract, and they can change those costs if they experience claims that they don't like. Just be aware, universal life, the hole keeps getting bigger and bigger and bigger. And if you're using a loan against a life insurance policy, not only do you have this hole, but now you come in and put a loan on top of that. We see these things eat themselves all the time. All the time. When you get into 70s and 80s, and two things happen. Either the insurance company says to you, write us a gigantic check, or your insurance just has got to go away. Let's settle out with whatever cash is left, and thanks for playing. And it just became really expensive term insurance. So it's not evil, it's just the question of if you're doing this, if you're doing a loan and you're doing tax-free banking against this and your insurance cost is rising, and then sometimes they add one more factor, and here's the factor. The factor could be, what's this? What's this look like to you guys? Huh? Stock market. What if this gets huge, you've got a loan, and we hit this like 2008? What happens? They cannibalize themselves. That's a lot of pressure to put on a single dollar when your costs are constantly going up and you have to make sure the market is here to make sure your costs don't go through the roof. So it's just a different product. Whole life insurance is simply this. You've got a guaranteed death benefit. It's got to go up. You've got a guaranteed cash value. And your premium, although higher than universal life, is averaged out over the course of your entire life for your death benefit. That's the only difference. It's actually guaranteed to not go up. Does that make sense? Okay, I know it's a lot of education on insurance. This is 12 years getting funneled onto a dry erase board, but are you guys okay with this? Okay. Questions?
On the loan against the whole life
Yes.
policy, what is the term typically, payment requirements and things like that against that money that you're borrowing from yourself?
Great question. The terms are you can switch to an unstructured loan and just pay the interest at your discretion. And once a year, you pay your interest. If you have the cash flow, and we recommend be good to your bank, pay back principal and interest. But the terms are what you make them. In other words, you just pay the interest once a year on the date.
Your term could stretch out 20, 30 years if you needed to, as long as you're paying that interest.
What's interesting, and we can show you guys examples, is
And there's ways, like you said, paying on the premium would be a good idea, but could you invest any profits from a business back, I guess, back into that whole life policy?
you can.
rather
Yes.
than paying down the principal?
Yeah, you can. You can overfund it to the limit that the life insurance contract will allow you to. You can do an unstructured loan. You can, and I tell people this kind of jokingly, but it sounds fun, pay back the loan or die. Because what happens when you die? When you die, they pay off the loan plus interest.
Right.
So if it's farther enough down,
Your whole life policy would only pay out the difference of the loan.
exactly.
So the whole life policy might not pay out much when you die, if you haven't paid back that loan.
Well, so we monitor that to make sure you haven't not only sucked all the life out of the life insurance policy, gotten a gigantic interest loan on it, you're doing nothing with it, that's going to eat itself. So you have to treat your bank well, right? But yes, you can actually not only pay the loan and the principal back, but you can actually reinvest dollars up to the limit that we can, for example, on that $100,000 example, that's the limit on one policy. You can have, one of our partners has 45 policies. You can have as many as you want, as long as you're healthy, or you find people that are healthy that aren't homeless that you actually know, right? Does that make sense? You have to have a financial interest in those people that you're insuring. So that could be business partners, that could be family members, that could be, my kids. Pick something. But those are great questions. So the terms of the loan are what you make them. You just have to pay the interest per year, and we have to take care of your bank.
It's healthy, all the standard stuff, you know, your blood, your weight and all this business, and age. But
Family
still
history.
age is a part of the calculation.
Cancer history, pending surgeries, medications, they're watching all
Genetic history.
that. Because remember they're gambling? They're going to study you on a $10 million policy.
Yeah.
They don't want to necessarily, they want to charge you the right number if they're going to pay it out.
So Sean, explain the difference between an insured and who owns the policy.
Yes, the owner is the quarterback. So the owner is the decision maker for the policy, is the legal voice for the policy. The insured is who you've picked to insure. So the insured is just the person that when they die, that's who the death benefit gets paid out to, the business or family or whatever entity you pick that's financially connected to you.
But as a quarterback, you get to choose how much you want to borrow against the cash value.
Yep,
It has nothing to do with a decision or permission of the insured.
correct. The insured is just the body. Not to be crass, but yeah. Funniest, real quick story. So I moved to Colorado and I picked up 2 orphan policies with my agency that I came up here with. And it was a divorced couple, 2 doctors. She hated him, like with a vitriolic rage. They were in a divorce settlement, and as an attorney, you know, they had to have life insurance on each other, $1.5 million each. So I call them both separately. He seems really nice. She's like, that son of a mother, like, right. I mean, just, I'm like, whoa, hey, nice to meet you too. Like, she hated this dude, right? He had brain cancer, 10 years. He just stayed level. He was on disability and just kept getting his $16,000 a month tax-free disability check. Tried to go into work, couldn't make it, just sat at home and collected. And literally, we're talking, and he's fine. This is July when I moved here in 2014. So I'm like, all right, man, let's keep an eye on it. I called the wife. I'm like, she's the owner. I said, do you want to change this over to a cash value policy? What if he keeps living? You want him dead, right? What if this guy keeps living? If he makes it another 5 years, you're not getting anything. She goes, he's got to die. I'm like, okay, it gets better, wait. So this is my favorite story, like 12 years, this is it. So this is getting recorded, right? I'm not gonna use names, okay. So he starts going downhill, right? And literally he's in a wheelchair by November, colostomy bag in December. January he's dead, right? She gets the 1.5 million. I call her up and she's like, that GD, just hating this. I'm like, he's dead. Like, what else can you do? Like, he is gone. She's like, and she works actually at a research hospital. She said, of all the places he could have donated his body, I walked in this morning and there he was on the slab. Just to give her a little more. Financial interest. You have to have a financial interest in who's insured. And the legal documents, the business documents, all that spells that out. But isn't that a great story? It's horrible, but she's really nice now. She got over her anger, but yeah. Does that make sense?